America is drowning in debt. $39 trillion of it. To put that in perspective, if you spent $1 million every single day since the birth of Christ, you still wouldn't reach the first trillion. That represents less than 3% of the current U.S. obligation. This debt works out to roughly $114,000 for every single American. While the public is told this weight is safely managed by the government's full faith in credit, the math suggests a different reality is being obscured. The stability of the U.S. economy currently relies on a global operating system that few citizens ever voted for. It is a mechanism that effectively requires the rest of the world to use the dollar for their own survival. This global requirement creates an insatiable demand for U.S. currency, which allows the Federal Reserve to print money without immediately destroying the purchasing power of a domestic paycheck. Trillions of dollars are soaked up by central banks in Tokyo, Frankfurt, and New Delhi to keep their own infrastructure running. Now, that system is starting to crack. Countries controlling nearly half the world's daily oil supply are moving to dismantle this arrangement. When the structure fails, the resulting economic shift won't just impact the government, it will land directly on you. The foundation of this system dates back to 1971. Facing a drain on gold reserves and rising deficits from the Vietnam War, Richard Nixon abruptly announced that U.S. dollars were no longer convertible to gold. He canceled the post-war financial order with no warning and no vote. The immediate result was chaos. Without the gold anchor, currencies floated wildly, leading to a massive spike in inflation. By 1973, an Arab oil embargo sent prices quadrupling. Gas stations ran dry, and the American economy was brought to its knees. To save the currency, Henry Kissinger brokered a deal in 1974 with Saudi Arabia. The terms were simple. The U.S. provided a total military security guarantee, and in exchange, the Saudis agreed to sell their oil exclusively in U.S. dollars. Because oil is the world's most essential traded good, this deal meant every country on Earth suddenly needed dollars to buy energy. If you wanted to turn on the lights in Paris or Mumbai, you had to acquire American currency first. To manage these massive oil trades, foreign nations began holding enormous reserves of dollars. They reinvested that cash into U.S. Treasury bonds, which effectively meant the rest of the world was now financing Washington's federal spending. This constant global purchase of American debt keeps bond prices high and yields low. Because mortgage rates track these yields, this foreign demand has served to artificially suppress interest rates for American homeowners for decades. This arrangement transformed a vulnerable currency into a strategic financial toll booth. It allowed the United States to fund its military and domestic expansion, while making other nations foot the bill through their own necessity for energy. This dominance was often taken for granted until 2022. When Russia invaded Ukraine, the G7 nations froze approximately $300 billion in Russian reserves and disconnected their banks from the SWIFT messaging system. Watching this, countries like China, India, and Saudi Arabia realized that dollar-denominated assets were no longer just neutral reserves. They were potential targets. If the US could freeze Russia's money, it could do the same to anyone. Rather than just protesting, China began accelerating a technical alternative. It is called mBridge, a digital payment system designed specifically to route around Western financial oversight. Today, most international transfers must bounce through a chain of Western intermediary banks to settle in dollars. mBridge allows direct central bank to central bank transfers of digital currencies, completely bypassing the SWIFT network and the US oversight that comes with it. The impact is already visible in the oil market. China can now purchase millions of barrels of Saudi crude using the yuan via mBridge. For the first time in 50 years, the most important commodity on Earth is being traded at scale without touching a single US dollar. These rival nations aren't seeking to destroy the dollar's toll booth through direct conflict. They are simply rendering it irrelevant by building a new digital road around it. The loss of a global reserve currency is rarely a sudden, apocalyptic event. Instead, history shows it is a gradual erosion of a nation's ability to project power and maintain its standard of living. When the British pound lost its status, the cost was felt by its citizens through decades of emergency bailouts and persistent inflation. The pound didn't disappear, it simply became less relevant, and the British public absorbed the resulting decline in their relative purchasing power. This chart tracks the dollar's share of global reserves, which has dropped from 85% in the 1970s to roughly 58% today. This is the lowest point in 2 decades, signaling that the global habit of holding dollars is beginning to break. As the world needs fewer dollars for energy, foreign central banks have less reason to buy U.S. debt. When the volume of foreign treasury bond purchases drops, the price of those bonds fall. When bond prices fall, yields rise, and mortgage rates follow those yields almost exactly. Between 2021 and 2023, the monthly payment on a standard $400,000 home loan jumped by $1,300, showing how sensitive the American lifestyle has become to these shifting debt markets. The era of the world subsidizing the American lifestyle is shifting. As the structural demand for the dollar erodes, the hidden mechanics that once suppressed domestic interest rates are losing their grip, leaving the U.S. economy to face the consequences of its $39 trillion debt on its